Hey everybody, Trader Dave here. Wanted to thank you for joining us for the Invest Signals Systems and Trading Psychology video, where we take a look at the role that having a great, robust trading system really helps with the psychology of the trader. This is the mandatory disclaimer page required by the regulators. If you have any questions or would like additional information, please go to our website at www.investsignals.com. The first thing I wanted to share with you are some of the traits that are shared among some of the best traders that I know in my trading career. The first thing is having the right mindset. And a great trader understands that trading really is 90% psychological, if not even more. It's one thing for your system to give you a signal, but you also have to be able to get into that trade, believe in the system, manage the trade, and most importantly, exit the trade. The second thing a great trader understands is that losses are acceptable. It's a part of doing business. Anybody that's ever told you that they've been trading for years and they've never lost ever, I wouldn't walk away from them. I would run away from them because it's just not true. Every great trader through the history of trading has had at least a loss. Understanding the skill set of great traders as well is very important. And a great trader understands the overall market. They understand what the overall economics of the market are. They understand what the Federal Reserve's stance on monetization in the economy is. They also understand price action, and that's really the keys to the kingdom. Really understanding what the charts are telling you and understanding the pattern recognition. Are we double topping? Is this a head and shoulders pattern? Are we at support? And also understanding what the trend is and recognizing the trend line. So are we going up? Are we going down? Are we going sideways? And having a system in place for each of those three different market scenarios. Having the right tool set is also extremely important. So having the right system in place, and that's where we feel investsignals.com comes in. Also being able to let your profits run and limiting losses, great money management techniques, good entries, good exit. That's what it's really all about. Now this is a slide a friend of mine had said he had found and he sent it over to me, so I'm not sure exactly who to give credit to. So if this is your slide, please let me know and I'll make sure we give credit to you. But this is one of the best slides I've ever seen on psychology. It really talks about the roller coaster of the emotions in regards to a trade. As you can see over on the left-hand side, you enter a trade with a lot of optimism and excitement. You're excited that you're in a trade. You're waiting for it to go up. The trade's starting to go up. You're getting thrilled about it. You can see that you're into euphoria. And then as the trade starts to level out because it could have topped, you start getting nervous a little bit. You get nervous that that you're holding on too long. Should you sell? And you start feeling those emotions of should I stay in this or should I sell? And then as the stock starts going down or the security starts going down, you start going into denial mode, which is really about you saying, you know what, it's going to go back up. I know I'm right, and I'm going to deny the facts of the market, even though there's a lot of sellers in the market. And then as you keep going down into the fear slope, the fear slope that's indicated by the red arrow, you start getting into fear that you're going to start losing money or that you're going to come to break even or that it's going to keep falling, but you still don't sell. And then you start getting desperate. You're back at break even or you're even at a small loss. And now you're like going, oh my gosh, what am I supposed to do here? Then you go into panic mode, which is, uh-oh, I've got a big loss here. I'm not sure what I'm supposed to do. Do I hold on to it? Do I sell at the bottom? Do I just get out of it? And then there's something called capitulation, which is where the psychology over the retail investors usually comes in, where there's a lot of selling all at once. They're saying, you know what, I'm just going to take my loss and I'm going to move on. And then all of a sudden, that's where the bottom starts to happen. And so you go through a capitulation stage and you get despondent. So the despondency stage is where you're just like shaking your head. You just can't believe what just happened to you. And then you go into the depressive side of it, which is like, I'm just down on this. I'm not going to be able to make it as a trader. This isn't for me. I'm going to have to go to work on Monday morning and see the group of people I'm not very happy with, or whatever your situation is. And then all of a sudden you get back in, or you've stayed in, and the stock starts to go up a little bit because you did stay in, and you start to feel a little bit hopeful, and then you start to get a little bit of relief that it's starting to go back up, and then as soon as you break even, you're at the optimism phase. But I think what's most important is that, when you get to a topping pattern, the greed mechanism starts to take over, and you can see that box up there on the top left-hand hump there at the top, maximum financial risk. This is where you're going to give away all your profits and possibly give away some of your own money. So you're going to give away all your profits and then start losing. So the best thing to do is to make sure you have a great exit plan. And then you can see that if in the event that you did actually stay in, the fear mechanisms take over. And then towards the bottom where everybody else has gone out, and if you, in case you're still in it at a loss and you're trying to get to break even, this is actually where the maximum financial opportunity is, down there at the bottom. So what we try and do is we try and get out at the top or as close as we can, or we let the profits run and we start to scale out. And we also try and get in at the maximum financial opportunity phase where we can maximize the gains and get in maybe when other people aren't necessarily getting in, but they're getting despondent, and the capitulation is starting to get into. So let's talk about why having a great system in place helps with this trading psychology. Now, why do signals matter? Why don't we just buy something and just hold the thing? Let me tell you why signals matter. We love trading with the trend. And let's take a look at the SPY, which tracks the S&P 500 again, on a long-term basis. So the SPY came out in the 1990s, and I wanted to show you what our long-term trend indications actually did with the SPY long-term. So you can see the different buys that were here and sells that were here for the different time periods. So for instance, you would have bought at the end of February of 1995 at $49.02, and that's a closing price. The C stands for closing price. Then you would have sold at the end of into the fall of 2000, in September of 2000, at $143.63. And if you remember, that's before the internet bubble had actually burst. And then and then if you wanted to sell short, you could have sold short at $143.63 and bought at 84.74. And you can see the other three trades as well in November of 2007, November of 2009 before the financial crisis, and then as of the end of December of 2013, the SPY was priced at $184.69 on a closing basis. So if you were to buy and hold just the SPY at the end of February of 1995 through the end of December of 2013, you would have made 135.67 SPY points. Not bad at all. But if you're only doing the buys and you only took the buys because you didn't feel like shorting the market or betting against the market, you would have made almost 100 points more. So you would have ended up with 233.28 points. And if you took both buys and sell signals, you would have ended up with 330.89 points, almost 270% more than if you just bought and hold. So what does this actually look like on a graph? So the results showing us the money, the equity curve for the SPY alone since 1995. So this is if you took all the signals and you started with a $10,000 investment. Over the last, is that 18, 19 years, you would have turned that $10,000 into almost $160,000 just by trading those very few signals. So let's take a look at some of the different methods in calculating the profitability. So if you were to do a buy and hold strategy, you would have invested $10,000, and at the end of December 2013, it would have been worth $37,676.46. That's not bad at all. So your net return on investment over that time period would have been 276.8% or 7.26% annualized. Now, if you only bought the longs, that $10,000 would have been worth $86,350 or a profit of $76,350, almost 2.5 times as much as the buy and hold. So that would have been a 763.5% return or a 12.07% average annual return. Now, if you took all the longs and the shorts on the SPY during that time period, your $10,000 would have been worth $153,498.22 at the end of 2013 for a net profit of almost $143,500. The return on investment estimated would have been about 1,435%, which on the average annual return, it's over twice as much as the buy and hold at 15.5%. And when you're compounding interest, that actually is an incredible differentiator between 15.5% and 7.25%. It means that you would be doubling your money almost twice as fast with the long and the short strategy versus just the buy and the hold strategy. So what does this look like in regards to our last 12 closed system trades? So you can see these are actual trades that were made. These are the net profits. You can see that there's not only ETFs but also stocks and also an options trade in there. The first few we actually had small profits, and the reason why we did that is because we saw changes in the market that required us to get out, so we were still able to get out, including commissions at a profit. You can also see some of the stocks that we invested in, like Travelers and then Becton Dixon down here, and those had pretty decent returns. Those were just a matter of days making some money on those different trades, and then we also saw some changes in the market that made us get out of those as well. And as you can see on the bottom, we bought option contracts on the 3x leveraged ETF for the S&P 500, and we bought options on that, and we made in 10 days we made $7,520.94 in profit. So we try and limit exposure to more than 2 weeks in any different security. If we see some sort of if we see a lot of strength, we will definitely stay in if we're long. If we see weakness across a sector, or if we see it in the overall market, we will definitely pull out of it. I would rather take a small win than a small loss or even a big loss. And we also try and limit our trades to a couple of weeks. We want to make sure that we're not exposing ourselves to the more market action. The longer you stay in the market, the more ups and downs you're going to see and the more exposure you've got. So as you can see, having a great set of entry signals and exit signals is very important to the success as a trader. And to be a successful trader, you also need to have the right psychology. And you can see how this all integrates with each other. To see what else we're doing and to take advantage of our $1 trial offer, please visit us at www.investsignals.com. This is Trader Dave. Thank you very much for your time.